Welcome to this crash course on the basics of investing, where we'll be demystifying the idea of investing. Whether you're investing in the United States, the UK, Australia, or South Africa, these basics are exactly the same for every single person. So if you've found us because you have an investment and you have no idea what's in it, or you would like to start investing, we're going to be demystifying the idea of investing. We'll be talking about where to put your money, how to make it grow, and how to keep it safe. We'll touch on some tax advantageous things at the end. So let's go. Right, so the first thing we'll look at is where to put your money. Now there is only 4 places to put your money, and these are called your asset classes. They have different attributes. Some of them would be for short term, others would be for long term, and we'll go through each one of them. The important thing that I just state right at the beginning is that when you're investing, you want to be beating inflation. Inflation is how your funds lose value year on year. Now you want to be beating inflation. Now I've got inflation listed here. You'll have to squint to see it. The little grey line right above the green line there, that is inflation that has been put on this slide. Now you'll see this data is from 2004 to 2024. And this is real stuff. This is no manipulation. This is the actual numbers that have come off with regards to South African asset classes. Right. The first asset class that we will talk about is cash. Now, cash is the green line. You will see it is never negative. However, over the long term, it is definitely not the outperformer. Now, what cash is perfect for is if you're saving up money, funds to buy a house or for a wedding, or for education in the next couple of years, 2 or 3 years, cash is the perfect place to put it. You take very, very little risk, if any. However, what you have to remember about cash is you do not always beat inflation. And that is a really important part, especially if you've got a long-term investment. You do not want to have very much cash in there at all because it won't be beating inflation. So that's our first asset class, which is cash. And that is money in the bank. Very, very simply, you have a savings account at the bank, a 32-day account at the bank. That is cash. The next asset class that we'll look at is bonds. Now, this is the grey line here. You will see there's a couple of wiggles, through COVID. There's a couple of wiggles in the line. However, it is not a very volatile asset class in comparison to the others. Now, historically, bonds have performed at inflation plus 2%. Over a long-term time horizon. At the moment, South African bonds are amazing. They're doing really, really well. Inflation plus 5%. However, what's important here is how does a bond work? Well, what a bond is you lend money to the government. Let's say you lend R1 million to the government. They will pay you interest every year through the 5 or 10 years, whatever term you choose. And then at the end of that term, they'll give you back your capital. Your R1 million. Now that is how a bond works. You wouldn't necessarily be buying that, but it might be part of your unit trust or your ETF. You would have bonds in there. Right. So you can see that it's not performed as well as other things. However, it's a more secure investment and it's considered for someone in retirement trying to earn an income. That's where bonds are considered. The next asset class that we have here is property. Now, property is the orange line. You can see in South Africa, it did really, really well at this period of time. However, it really battled through COVID, obviously took a big knock. And as you can imagine, there's many empty offices that haven't been rented out yet since. And now how property is invested in your unit trust or ETF or endowment or whatever you might have is via REITs, which is a real estate investment trust. Now, this is something listed in South Africa on the Johannesburg Stock Exchange. And how that works is it is property funds, a property company that is listed. As you can see here, it might be very volatile in any time. And you can see if we go from cash, bonds, property to equity, property is a lot more risk than cash and bonds, and you can see that in the volatility. However, over the long term, the chances of this is not guaranteed, but you can see the real data in front of you. The chances of you outperforming cash and bonds is a lot higher when investing in property. And these are REITs that we're talking about. The last asset class that we have here is equities. Now, this is the stuff they make movies about, right? And you've seen it. These are shares listed on the stock exchange, like the NASDAQ or the London Stock Exchange, Johannesburg Stock Exchange. And this is, you just take a look at the blue line is South Africa. You can see that this is very volatile. In any time, you can put funds in and have it be negative the next day or a month later. It is very common for funds in that whatever's been invested in equities to be negative. This is not a problem. This is the price you pay for long-term outperformance, is that short-term volatility. Now, if you're a young investor with a long time horizon, equities is what you want to be invested in. So we've got the blue line, which is South African equities, but what I have added here is the United States listed as the red line. And you can see that is just as volatile. However, there is extra volatility there because you've got exchange rate issues there that are making it more bouncy. That to use a nice and easy word. Basically, if you bought an investment in rands and that investment was holding dollars, all of a sudden, let's say the rand loses value, well, it makes the dollar look so much better. However, if it goes the other way around and the rand gains value, the investment might look negative because the dollars lost value. And that's just an important thing when you're investing offshore. You need to extend your time horizon to a minimum of 7 years to deal with that volatility. So these are your 4 places to invest: short-term, cash; long-term, equity. You can have if you have a retirement annuity, it's a balanced fund. It's a combination of all 4 of these, but this is what you would have in any investment. This is such a simple side. I say simple, and it's got a bunch of wiggles all over it. But if you just look at the colors, short-term cash, great for the short term, not great for the long term. Bonds is taking 1 step up on the risk factor. Property, another step up on the risk equation. And then equities, you can see it's very volatile. However, over a 20-year period, you're much more likely to outperform with equities than you would be in cash. So that is the where you can put your money. It is super duper simple: cash, bonds, property, equity, and you make that decision with any investment. Pre or post retirement, those decisions and conversations need to be had. Now, we'll talk about how to make your money grow. There is no secret magic on how you make your money grow. You might have one fund manager saying they know how to buy shares at a low price and make a profit, but don't believe it. The only way to make your money grow is time. I call this your money's best friend, and it is compound interest that enables your funds to grow. So we've got an example here, a very, very simple example of Tom and Jerry. Tom invests 2,000 Rand per year for the first 8 years of being out of school. So that's 19 to age 28, versus Jerry does nothing. Now, I have a slide that just zooms in so you can see it's a little bit better. And you can see here, Tom investing 2,000 Rand per year for the first 8 years and then never invests ever again. Versus Jerry, who does nothing for the first 8 years of being out of school and has a big party at varsity and with his first job. Thereafter saves 2,000 Rand a year all the way until retirement. Clearly, we see that Jerry has saved a whole lot more than Tom. However, what are the values at the end here? We've got 2.2 million Rand versus 1.5 million Rand. This is mind-blowing, and this is the secret sauce to investing: time. Compound interest is amazing, and many people think an investment grows in a straight line. However, it doesn't. It grows like a hockey stick, and it really grows over the long term. Right at the end, it does all its magic. And I'll show you, if you just look at the last 6 years here, you've got from age 60, Tom grows from 1.2 million Rand to 2.2 million Rand, almost doubles in that last 6 years. And the same on the other side, goes from 800,000 to 1.5 million Rand. That is an amazing trajectory. That is right at the end of the graph, the last couple years. And it's a good point to maybe working a couple extra years if you're nearing retirement and you don't have enough, but also the importance of starting early. If you have a kid, there's a wonderful thing called a tax-free savings account, and I would suggest anybody do that for their child. But starting early is way better than starting late, and if it is late, starting now is better than later. So this is just how to make your money grow. It is simple. All it is time. Compound interest does its magic. It's how your money babies have money babies who then have their own money babies. And it is quite significant and quite exciting. And the final thing we'll look at is how to protect your money, because the one thing you don't want to do is lose it or lose all of it. And there are many people that offer amazing returns, which aren't real returns, and people can put their funds at risk by taking on pyramid schemes and the like, and scams like that. So what's really important is to diversify. This is the major thing that can protect your money, is diversify. And it's the good old lesson, don't put all your eggs in one basket. So don't buy just one Sasol share because you believe it's going to outperform. You buy a basket full of a whole bunch of shares, so that if one goes up by 100%, it's also not going to be it's not going to have a huge effect. However, if one goes down by 100%, it also won't have that much of an effect. It's about spreading your risk by diversifying. Now, there's many different ways to diversify. One would be asset class. Don't have everything in equities, don't have everything in property or bonds or cash. Have a bit of everything. That's the first way to diversify across asset classes. The second is to diversify through geographies, so different countries. If you want to be invested in the tech sector, you won't have very much exposure if you're just invested in South Africa. So you have to go offshore to have exposure to the tech sector and the great new things that are happening around the world. And you will find that many investors, if they have a retirement annuity, which is majority invested in South Africa, if they have a pension fund at work or a business in South Africa, everything is in South Africa, and they must consider investing offshore, which is way more volatile because of the exchange rate that adds to it. However, it is something that should be considered by any investor. And then sectors, you've got to invest across different sectors. And I just mentioned tech. There's not very much tech available in South Africa, but you can have access if you invest offshore into stuff like that. And different investment strategies. Now, different fund managers have different ways that they do it. They might be value investors or invest for income. They've got different ways, and we don't know if one is better than the other. Everyone will say it is, but we don't know. Well, the answer is to have both, because we don't know which one's better. So have both, diversify across different investment strategies. A really important point is to stick to your philosophy. Now, you have different time horizons, as I explained on the slide with the different asset classes. If you're invested in equities, it is a long-term time horizon, minimum 5 years. Now, if you invest in equities and a year later we have another COVID and the fund goes down 30%, you would be very silly to disinvest and to take your money out of that investment, because you would lock in that loss. You've got to stick to the time horizon. So if you put an investment in place, you say, right, this is an investment for 10 years time or for retirement. Whether it is negative 50%, it does not matter. You leave it there until you've hit your time horizon, the time that you've said. So you've got to give the asset classes the opportunity to perform through the volatility that will come. It's not about if it comes. I guarantee you that there'll be another market crash. Guaranteed. The point is to stick to your investment philosophy. Right, an important point which I'll show another slide on, which is keeping it cheap. Fees is something you're guaranteed to pay no matter what. Whether the fund is negative 30% or positive 50%, you will pay fees. So it's something to really investigate. How much are you paying for the investment you hold? You have different philosophies, active versus passive. Active investors would be buying and selling to make a profit, which would require people to investigate different cycles of the market, to investigate different shares, and that costs money, and that would make it a little bit more expensive. Whereas passive funds don't buy a single share, they buy the entire market, they do a whole lot less, and so it's a lot cheaper. I don't know which one is right or wrong, but I do know that you pay in fees in every investment that you have. And the point is, diversify, have both. Have an active portion to your portfolio as well as a passive portion to reduce the fees. And traditionally, passive funds are invested in ETFs, which is electronically traded funds. Right, and the last thing I just wanted to point out is educate yourself, because knowing these basics helps you avoid common mistakes. And I see mistakes all the time, whereas people have invested and then disinvested at the wrong time because they've been scared and they haven't been coached through the market's cycles that come along. So that's how to protect your funds. Diversify is number one. Now I just wanted to show you one slide with regards to fees, and this is phenomenal. Right, the average fee in South Africa is about 3%. Now this is an investment of R1,000 per month done over 40 years. And I just wanted to point out what high fees can do to an investment. It can decimate an investment. Now, if you have a 3% fee, you're going to be looking at more than 50% of your growth has been taken away from fees just because of the cost. So ideally, you want to have about a 1% fee. That's still 20% of your growth gone to fees. And I just want to read out the numbers here. So at a 0% fee, you would have 13.7 million Rand. However, with a 3% fee, you're looking at 7.2 million Rand at retirement. That is a huge number. And remember that you might have 20 years to retirement, but then you'll have 20 years in retirement. This 40 years is not too long of a time horizon, and it's something that's really important to make sure that your fees are low. It's not just me saying it. The South African National Treasury said it. They said a regular saver who reduces the charges on their retirement account from 2.5% of assets each year to 0.5% of assets annually would receive a benefit 60% greater after 40 years. That is just remarkable and just so important that you look at your fees and you figure out what it is you're paying for and whether it's worth it. It's something that I talk about all the time, and I just find very exciting, where you can reduce someone's fee by choosing a passive fund or a portion of it in a passive fund to give them a much better outcome at retirement. And this is just where I will point out, it is so important to pay for advice, not to get free advice, because free advice comes with a retirement annuity that's full of commission, and your fee is going to be way beyond 3%. Whereas if you pay someone to implement a retirement annuity, you pay that advisor for their skill and their knowledge, you will get a 1% fee and a way better investment over the long term. However, you have to pay for it, and that might turn you off. But free advice will cost you your retirement. Guaranteed. Make sure that you pay for your advice. And lastly, I just wanted to give you a little tip, which is investing is like a bar of soap. The more you touch it, the smaller it gets. And this happens when you go play golf with your mate, and your mate says, well, I'm invested in the XYZ fund and it did 30% last year. You do it too. Well, the chance of that fund doing 30% 2 years in a row is very, very slim. And so moving to that fund that has done really well is not the answer. You've got to stick to your philosophy, what you set up at the beginning, doing it right for the long term. I wanted to just point out some tax advantageous things that you can take advantage of. In South Africa, we have one of the best investments, which is a tax-free savings account, where you can contribute 36,000 Rand per year We're doing this in 2024, so 36,000 Rand per year, a lifetime limit of 500,000. This is your never touch money. You put it in there, you leave it for when you're in retirement, you will be able to draw a tax-free income from it. It's phenomenal. The other option you have is a retirement annuity, which was a private retirement fund where you contribute into that. Your contributions are tax deductible to a certain amount, this is something that you should consider too. The other thing is, if you're employed, you might have a pension or provident fund. These are other tax advantageous funds. That, you know, the growth in these, everything I've mentioned so far, the growth is tax-free. That's the dividends are tax-free. There's no capital gains within the fund, and the interest in that fund is not taxable. So that's what is important about the ones I've mentioned. If you're a high income earner and your tax rate is above 30%, then you could consider an endowment, because that's a tax at 30% within the fund. So if you're at 40%, you're going to be saving 10% of that. And those are some of the funds that you can use. You can use a straight unit trust. There's no real tax advantageous things to that. However, if you harvest the capital gain every year, that can be beneficial for you over the long term. Please take an opportunity to pay to go and see a financial advisor, get their advice. If you're moving, if you're growing and you're getting a little bit more complicated, you might very well need to see a financial advisor. You can come and see me. I love sitting down with people, getting investing really, really simple and concentrating on retirement, because that is something that statistically is most likely to happen to you. Retirement will happen, and you need to prepare for that. Small little sums every single month over the term of your working career. So that is the basics of investing for you. I found this really exciting and great to walk people through it, and I would love to sit down with you and guide you through some of the decisions that need to be made. So thank you.